Hello, money and banking students. This week we're going to look at the monetary policy tools that the central banks have at their disposal to help influence monetary policy and control the money supply. In this first section, we're going to attempt to answer three questions. What three monetary policy tools do central banks have at their disposal? What are the strengths and weaknesses of each? And what is the federal funds market and why is it so important? There are three primary tools that the central banks have for influencing the money supply. The first is the reserve requirement, and as we've learned, that's the amount of money banks are required to have in reserve. Currently in the U.S., it's generally 10%. So to increase the money supply, you decrease the reserve requirement, and to decrease the money supply, you increase the reserve requirement. Second tool is discount loans. These are loans that member banks receive from their district Federal Reserve Bank. Federal Reserve Bank can increase loan interest rates to decrease the money supply, and they can decrease the loan rate to increase the money supply. And then the third tool is open market operations. As we learned last week, open market operations are conducted by the Federal Reserve Bank of New York. They buy and sell securities, generally government bonds. So to increase the money supply, they buy securities, and that injects cash into the markets. And to decrease the money supply, they sell securities. As we learned in the last chapter, the reserve requirement has an influence on the money multiplier. So the larger the reserve requirement, the more that it constrains deposit expansion. The central banks don't use or don't change the reserve requirement very much. It's the most rarely used tool in their arsenal. Discount loans, and specifically the interest rate charged on discount loans between banks and the Federal Reserve, is a tool that is used by central banks. And obviously, the more loans that are made, the more currency that's in circulation. When loans are repaid, that takes currency out of circulation. The tool used most often by the central banks are open market operations, where securities are bought and sold to increase and decrease the money supply. The Fed funds rate, and that's the rate that banks charge each other to borrow money, is a tool that is used quite frequently by the Federal Reserve. So, when banks need to borrow money, they can borrow from other banks overnight or for a longer period of times, and the Fed funds rate is the rate that is charged. So the Fed can lower or increase interest rates, and of course that can have an effect on borrowing. Typically, it's less expensive for banks to borrow from each other than it is to borrow directly from the Fed. So typically the Fed funds rate is less than the discount rate charged by the Federal Reserve. It's also easier for banks to borrow from one another than to borrow directly from the Fed. There's more scrutiny from the Fed than there are banks between each other. So if the Fed's funds rate is less than the discount rate, guess what? Banks will borrow from the Fed funds market. Conversely, if the Fed funds rate is greater than the discount rate, what happens is arbitrage, where banks will borrow at the discount window and then lend in the Fed funds market. So we can say that the discount rate sets an upper limit to the Fed funds rate because no bank would borrow reserves at a higher rate in the federal funds market than it could borrow directly from the Fed. Now let's look at open market activities that the Federal Reserve can involve themselves in. If they want to do things to shift the supply, if they want to expand the monetary supply, they can purchase securities which will increase the supply of reserves, and that tends to lower the Fed funds rate. On the flip side, if they want to contract the money supply, they will sell securities which will decrease supply of reserves in circulation, and also raise the Fed funds rate. They can also change the reserve requirement, which will shift demand. So if they increase the reserve requirement, that increases the demand for the reserves and tends to raise the Fed funds rate, and vice versa. If they decrease the reserve requirement, there's a decreased demand for reserves, and that tends to lower the Fed funds rate. Bank liquidity needs can also shift demands. So if the bank needs more reserves, that tends to raise the Fed funds rate. If there are excess reserves and there's a decreased demand for reserves, that tends to lower the Fed funds rate. In Section 2, we're going to look at two questions. How does the Fed influence the equilibrium Fed funds rate to move towards its target rate? And secondly, what purpose does the Fed's discount window now serve? To get started, I would like you to pause this PowerPoint and go to Moodle and watch the open market operations video. Generally, the Fed has a targeted Fed funds rate that they want to try to achieve to keep the economy running smoothly. There are two different views or two different postures that they can take. A dynamic posture is when the Fed will do things to actually change the monetary base. So they're very active in changing things. The defensive posture is when they're trying to offset and keep the target Fed funds rate where it is, but they're doing things to offset other things that are happening in the economy. So in performing open market operations, the Federal Reserve Bank of New York, this list of things are things that they're checking on a daily basis in order to make buy and sell decisions with open market operations. Their open market activity can also have different time frames. Outright means that they've made a permanent decision to buy or sell securities. Repo is just an overnight purchase or sale of a security, and then a reverse repo is where you sell with the guarantee that the buyer will resell it to the Fed after the transaction. At this time, I'd like you to pause this PowerPoint and go into Moodle and watch the Fed's discount rate video. As was mentioned in the video, the discount window, that's where the Fed actually makes loans to member banks, is typically only used during a crisis when Fed funds market is not functioning effectively. The Fed is a lender of last resort and has the responsibility to ensure that banks can obtain capital that they need. But generally, the Fed, really its desire is that banks would borrow from one another. Those with excess reserves would make loans to those who are short, and vice versa. To motivate banks to borrow from one another rather than from the Fed directly, typically the discount rate to borrow from the Fed is higher than the Fed funds rate that banks charge each other. At the time that I'm recording this, because of COVID-19, we're in one of those crisis periods where right now the Fed funds rate and the federal discount rate are actually the same at 0.25%. So the Fed has lowered their discount rate just to provide liquidity to the market. Also in the crisis of 2008, we saw the Federal Reserve step up and offer all kinds of programs and credit facilities, again, to facilitate liquidity and circulation of cash in the markets. You've heard the term quantitative easing, and that's where the Fed purchased a lot of assets, bonds, to again inject liquidity into the market. And you can see, the goal was to decrease yields, interest rates on Treasury bonds, but also to increase the money supply. And because of quantitative easing, the Fed's balance sheet in assets swelled from less than $1 trillion to almost $3 trillion by August 2011. So I'm going to end this video, and then we'll come back with a second video to cover the second half of Chapter 16.